Right, good evening, everyone. Great to have you guys joining us in this webinar. Okay, just give me a moment. Let me zoom into full screen. Okay, so while I'm doing that, just a quick check that you guys are able to hear me. Okay, and of course, at the same time, we will have a Q&A session at the end of today's sharing session. So I will not have the time to monitor your questions as we progress. So I would suggest that if you have any questions, write it down. And during the Q&A session, that's where you'll be able to ask your questions, and I'll be looking through them and answer your questions as much as we can. Okay, so once again, really appreciate all of you tuning in live in this webinar. Okay, understand, timing wise is a little bit, some of you actually need to set aside some time to commit to this. Really appreciate that, and today I'll do my very best to make sure that whatever time you invested in this webinar will be worthwhile. Okay, so today topic will be on the investing presets. This is where I would like to use this opportunity to share with you some of the framework that I personally use to invest and trade in the stock market. Okay, so naturally the title here suggests like which one of these 6 strategies do you think will help you profit, right? They are actually the 6 components where I'm going to share with you the entire framework in today's sharing. Okay, so quickly, I'll spend about 1-2 minutes to quickly share with you a little bit about myself, especially for those of you who perhaps first time hear about me, okay, or first time actually see my face. I think it's very important for you to understand a little bit who I am, okay, and so that we'll be able to connect better throughout this sharing session as well. Okay, so I also like to quickly give thanks to CMC Markets for actually having me today, giving me this opportunity to present and of course share what I know with fellow traders and investors, right? I really enjoy doing that. Okay, so my name is Kar Yong. I've been trading and investing in the market since 2012. From there on, I've officially went into full-time trading investing in 2015. Okay, so right now I'm basically, other than just trading investing myself, I do conduct some sharing session, something like this that you guys are attending today. Okay, and of course, before the entire lockdown, before like last year 2020, where everyone is not able to travel, I used to travel around various cities and countries in Southeast Asia to conduct sharing as well. Okay, and I would like to really show you my performance for last year as well. Okay, of course, I know there are some investors or even traders who make a lot of money in 2020, but at the same time, I also know that there are traders who actually lost quite significantly last year as well. Okay, so more importantly here is not to compare the result. Okay, I'm not here to just give you guys some comparison, but I just want to show you that whatever I'm going to share with you in this webinar is not theoretical stuff. They are things that I personally use directly in my own trading investing. Okay, so this was my performance last year, 36.73% to end of the year. Okay, but more importantly over here, it's also good to know what is the risk taken to generate that kind of result. Okay, because if today you are very aggressive, very high risk, of course you are able to generate like 200%, 200%. That is doable in the financial market, but of course you need to understand the risk that you need to take. Okay, so for me, in order to generate a total of 36.73% last year, the maximum drawdown that I suffered in 2020 was 6.2, right? So to me, I'm a little bit more conservative, not too aggressive. Okay, so whatever I'm going to share with you today, right, the entire framework that I use to trade and invest in the stock market is actually being applied in my own portfolio. Okay, so what you're going to see today are very practical stuff. Okay, so for those of you, quickly, for those of you who like to follow me on social media, you can just search my name on Facebook and Instagram, right? Just type in my full name, you'll be able to find it and connect with me over there. Good. Okay, so let's get started with today's content. So what we're going to cover, by the end of this presentation, number one, you discover what is the 6 principles, 6 investing strategies, and which one will be able to help you profit from the market. Okay, I'm pretty sure out of these 6, maybe some of it are quite common that perhaps you come across before, but I am pretty confident that out of the 6, there will be maybe 1 or 2 perhaps you never really heard of it before, right? And today is where I have this opportunity really to share with you. Okay, by the end of this webinar, you also have a complete investment framework. Ideally here is to help you gain insights to complete perhaps what's missing in your investing journey. And that would help you build a profitable investment portfolio, right? And last but not least, I will also use this opportunity to share with you some opportunities that you might want to focus on for at least the first half of this year, first quarter. Okay, and of course, some of these opportunities I'm going to share with you is beyond this year itself. Okay, so we are looking beyond like 2021, going into like 2022 as well. Okay, so again, if you have your pen and paper, I would strongly encourage you to write down notes. Of course, the slides will be given to you at the end of this webinar as well. Okay, so this is for you if today you're absolutely new, never invest in the market before, no worries, okay, because what I'm going to provide you today is a complete framework so that you'll be able to kickstart your journey properly. Okay, for those of you who have been investing some time, perhaps out of the 6 strategies, there are some component that is lacking. Okay, and today's webinar will definitely be able to fill the gap for you. Okay, so if you stay to the very end, you get this slide. Okay, so you don't need to like take photo of every slide over here. You'll be able to download it. Okay, and in this slide here is where you're gonna get like the latest market outlook as well as some of the companies that I'm personally looking at. Okay, I'll share with you throughout this webinar as well. What's the reason for me looking at that? Okay, because I personally believe that it's not just about stock pick. It's more about why, the rationale behind it, and of course from there you'll be able to learn, okay, and eventually apply it for yourself as well. Okay, good. So now I just want to very quickly get you guys to think about this question, right? When you hear about investing or when you hear about stock market, what do you often think about? Or when you hear about people saying like, oh, stock market, people are investing, what do you usually pop up in your head, right? Just for a few seconds, I want you to think like, what is the top 3 things that pop up? Okay, so for me, okay, these are some of the very common one, like value investing. I think a lot of people probably would have this keyword when they talk about investing. Perhaps growth investing as well, okay, or perhaps dividend investing. Okay, so these are basically some of the different approaches towards investing. Back then, I also, the first few things that came out with me is when people talk about investing, always we correlate it to like fundamental analysis. Okay, looking at how a company is doing and things like that. And of course, sometimes you might hear, or you might even think about like bonds, ETF, indices, stocks. Okay, so these are terms that relate to investing. Hey, or even passive income, right? So that's where a lot of people say that if you invest in the financial market, investing is one of the most powerful vehicle towards passive income, right? So these are very common. Okay, and I thought investing was all about fundamental, honestly. Okay, when I get started back then into the stock market, into investing, the one thing that I had was always about investing equal fundamental. Okay, and fundamental basically what it is like analyzing the corporate management, understanding the financial statements, looking at ratios, looking at the valuation of the company, whether this company is good, is solid, what is the quality of it, qualitative, quantitative analysis, right? So everything I thought about investing back then was about fundamentals. Okay, until then I realized, hey, how come sometimes, right, you realize that the stock price of a certain company can drop drastically even when, let's say, the company is solid. Okay, or even let's say when the company release certain positive earnings, is making very good outlook, is making good profits, but yet at the same time the stock market can collapse. Okay, and of course vice versa, right? Sometimes the stock market can rally even though the company is not doing good. Okay, so what's the reason behind this? Okay, and if you haven't realized PE over here, right, which is price to earning ratio, I also realized that how come sometimes when we look at PE ratios, okay, a certain company, certain industry, the PE ratio is already so high, but yet the stock price just continue to rally. Okay, so I started to figure that it's not all about fundamentals. Okay, even earnings report price does not really follow it. Okay, so I went to dig a little bit deeper and ask like, Why? How come the stock market price can be so different from the fundamentals? Okay, and that's where I started to discover, okay, investing is not just about fundamentals analysis, is not just about looking at whether this company is good or not. Okay, and that's where I started to find out what are some of the components, some of the frameworks, some of the factors that can affect a stock, okay, or in particular a stock price. Okay, so that's where it led me to discover this thing called the investing precepts. Okay, so in total there will be 6 principles towards it, and of course if you look at it separately, individually, that's where we have like the 6 strategies. Okay, and I would take some time to go into each of this to introduce them to you so that you understand them, and at the end of it we'll put them together so that you'll be able to have a complete and holistic understanding of where we are right now, what are the opportunities presented in at least for the first quarter of 2021. Okay, so the first principle within the investing precept here is what we call macro analysis. Okay, now this is slightly different from fundamental. So macro analysis, we are not really looking at a specific company or industry per se. We are looking at a global environment. Okay, that's why we call it the macro analysis. And understanding this is very important because, again, just now we talk about why stock price can move even when things are not aligned with it, right? At the end of the day, what moves the financial market is not your earnings, is not your fundamental report, is not your financial ratios. Okay, macro analysis here plays a very big role in moving the financial market. Okay, so what is macro analysis, right? Essentially, if I just to make it like simply for you to understand, it is the study of global market liquidity. Okay, and the word liquidity over here simply means how fluid money is flowing. Okay, now if I just give you some example, if you're following the market last year, you realize that globally a lot of central banks are printing money, they are lowering interest rate. Okay, so they are making the financial environment liquid. Okay, essentially means more money supply flowing in the economy, in the market. Okay, so macro analysis here, we want to study how liquid the market is right now in a global scale. Okay, and understanding macro analysis, we know that liquidity moves the market. Okay, the idea here is the more liquid the market is in a global scale, the more the stock market specifically is going to be supported. Okay, and vice versa. So if liquidity is low, then of course the stock market here will not be supported, and you tend to see price tends to retrace or even fall. Okay, so one of the biggest liquidity providers is actually our central banks. Just now I talked about it. In 2020, you realize that a lot of central banks globally are cutting interest rate and printing money. Okay, so that is increasing liquidity. It makes money flow easier. Okay, and when liquidity is loose, then of course, just like I mentioned, so market tends to be supported. Okay, so this one here is where you realize that, hey, how come when the economy is bad, the stocks can still rally, right? Just take a look in terms of 2020. Okay, globally the economy is not good. Okay, of course not all sectors, some companies are still doing well, but if you take a look at global economy, it's not good, right? People are being retrenched, unemployment rate actually shoot up, so economy is not good. But how come 2020, the year end off positive? Okay, the market actually end off positive. So the idea here is back to macro analysis, right? And this one here, I would like to quote one of the most famous macro trader, okay, Druckenmiller. So he actually mentioned this in one of his quotes, right? Whatever I do, I focus on central bank and focus on the movement of liquidity. That most people in the market are looking for earning and convention in terms of conventional measures, right? Like fundamental and things like that. So he said that liquidity moves the market. Okay, and that's exactly, you know, if I want to look up for case study, right? The closest we have like real tangible case study over here is already very right in front of us. March 2020, the market crashed, but at the same time, it just recovered very, very fast because of all the central banks starting to print money, lower interest rate, and they make the entire global market very liquid. Okay, so understanding macro environment is very important because it gives you the big picture. It gives you the confidence whenever you want to be participating in the financial market, more specifically the stock market, right? So over here, just wanted to share with you that there are many ways to track macro environment. Okay, this is just a method that I personally use to track the macro environment. Okay, you can see over here in this slide, on the left, okay, those are the macroeconomic indicators that I use to track it. Okay, so that helped me to develop this system over here where the maximum liquidity scoring that I have is 8, and the minimum, the lowest it can go is of course -8. Okay, so this here is updated as of December. Okay, later I'll show you the January one. Okay, every start of the month I update them. Okay, so this is updated on the start of December. You realize that the overall liquidity scoring is 5, which is pretty liquid. Okay, and that's where you see the year ended off, breaking new highs and things like that. But if I bring you to this year, January 2021, okay, you realize that we have dropped, the overall liquidity has dropped to 0. Okay, so that's where, to me, I know, okay, if the market environment is now less liquid than December, I want to be cautious because it means that it's suggesting and indicating to me that overall perhaps we might see a retracement coming in. Okay, it's not yet in the negative territory, but again, it's telling me to be cautious already. Okay, so this is very important, especially for those of you who are perhaps more active and looking to build up, entering into new positions this year. You might want to be a little bit cautious because based on macro environment, it seems like the liquidity is tightening a little bit. Okay, so this is something that you want to take note of. Okay, so this gives me the first framework, the first precepts in my entire framework of investing. Okay, understanding the big picture. Now, the second part here is where I then go into, maybe zoom in a little bit, right? Go into a smaller piece where I look at sector analysis. Okay, so again, this year, if you look at 2020, you see a lot of headlines, right? Where there is a lot of shopping malls closing down, retail outlets closing down. But at the same time, you realize that, wow, technology companies are booming, right? Performing all-time high. Their income, their profits are great. Okay, so where does this understanding come from? How come in the same environment some companies perform, some companies don't, okay, or even collapse? That's where sector analysis comes in. Okay, and what is sector analysis? Okay, so for you to really appreciate and understand sector analysis, you need to first know or acknowledge that the economy is not the stock market. Okay, this is a common misconception that many maybe newer investors or traders would have, is that they think that, oh, if the economy is good, the stock market is going to be good. If the economy is bad, the stock market is going to be bad. Okay, no, the economy is not the stock market. Okay, but what you want to then know is they have a close relationship, but they are not equal. Okay, and when we talk about economy, there are generally 4 business or economic cycle. There are 4 categories. Okay, and these 4 categories are going to affect your different sector in the market itself. Okay, so each business cycle will have a certain sectors that tends to perform better relative to other. Okay, so over here, okay, just give you some case studies, very tangible one that happened as close as like what we had in 2020. Okay, okay, so this, when I was designing this slide, we were end of the year, so the word here was this year. Okay, but this year here refers to 2020, right? No, not like 2021. Okay, so in 2020, you realize that when the lockdown happened, the economy is bad basically, and unemployment rate hit all-time high, right? This one here in respect to the US. Okay, but at the same time, there are certain companies like Zoom actually hit all-time high in their prices too. Okay, and over here, I would like to share you some of the personal stocks that I've been involved in. Okay, so these are case studies that is not theoretical. They are things that I personally traded and invested. So in Zoom, I got in at $183, and of course, the price rallied all the way to close to $500. And that's where I got up. Okay, so you realize that even though the economy is bad, there are companies that is performing very well. Okay, and the question here is, what is the method to identify which of the companies that you want to focus on during certain economic cycle? Okay, so over here, this is where I want to introduce you to this model. Okay, this is by Stem Stovall. If you just do a simple search on Stem Stovall model, you probably come across something similar. Okay, and what it does is that it breaks the entire economy into 4 cycles. So you can see on this chart here, you have the full recession, early recovery, full recovery, and early recession. And in the world that we're living right now, right, it's a cycle, which means it will always rotate among this 4, and it's always going in a clockwise cycle. Okay, so what you then realize is when COVID-19 happened, when we have a full-scale lockdown globally, we entered into full recession. Okay, and during this economic cycle, what you see is that sectors in the technology, sectors in cyclical, sectors in industrial tends to perform. Okay, and that's the reason why you realize that Zoom, Apple, Microsoft, in fact, some of the technology companies like Facebook even actually perform very well during this lockdown because of the sector analysis telling us during full recession cycle, this is where these companies tends to perform. Okay, so you realize that, and going forward into January this year, which is right now where we are for at least, I think, the first quarter of 2021. Okay, again, I'm utilizing some of these economic indicators to tell us which cycle we are in. Right now, you do realize, okay, at the bottom, you'll be able to see the red and green highlighted one. So you do see a mixture, right, between full recession and early recovery. So some of the indicators tells us we're still in full recession. Some of the indicators are already going into early recovery. So with this in mind, then you realize that, okay, we are in a mixed state. Okay, in the middle is a transition. Okay, but the idea here is we are slowly and eventually we're going to transit into early recovery. Okay, and if I were to transit into an early recovery economic cycle, which are the sector that tends to perform better? It will be your industrial, it will be your basic industry, and it will be your energy sector. And that makes sense in an economic point of view as well, because during recession, what will happen to fiscal policy, to monetary policy? The central banks will print money. Okay, the central banks will lower interest. What will government do? The government will actually start aggressively implementing fiscal policy by spending money. And most of this money will go towards where? Go towards industrial infrastructure, maybe energy is required because of demand and supply, right? And you see those sectors tends to perform because that's where the money is going to flow in. Okay, so if today you want to focus on a certain industry, a certain sector, for at least the first quarter of the year, or perhaps going into 2021 this year, these are some of the sector you want to focus on. Okay, industrial, basic industry, energy, basically infrastructure related. Okay, so this is from macro. We come down a little bit to a smaller scale where we look into the sectors of where the money is likely going to flow into. Okay, so hope so far so good, you guys are being able to follow through. Okay, now from macro, we go down one scale to the sector, right? So that's like understanding the big picture, zooming in a little bit. And then from there, we understand which sector industry tends to perform. Then the next step here, of course, is to understand the individual companies, right? And that's where fundamental analysis comes in, okay? And this becomes, right, one of the most popular one. Whenever people talk about investing, they talk about, oh, fundamental analysis, how well this company is performing. Okay, but you realize that without the macro, without the sector, if you jump straight to fundamental, you might pick a very strong company, but if the big picture doesn't support it, then you might be investing perhaps not at the prime or ideal time. Okay, so that's where, again, if you only look at fundamental, when I first started off, I always thought it's just fundamental. That's where I figured that there's so many missing pieces, right? Okay, but fundamental is still important because you want to make sure you're putting money at a company that is fundamentally strong. Okay, so what is fundamental analysis? I think this one here, many of you are already very familiar with. Okay, so it's basically the study of how well a company is doing. Okay, usually there are two categories to it. The quantitative, looking at balance sheet, financial statement, financial ratios, and there's a qualitative where you look at like corporate governance. Is the management good? Who is the leader? Who is the CEO? Okay, is there a growth factor in the company? And all these are qualitative. Okay, so both are important. Okay, and most of the time we'll be analyzing using financial ratios, right? Like P ratios, long-term debt to equity, etc., etc. Okay, so the key here is, again, I say fundamental is important, but it's not everything, because you want to invest in good companies. You don't want to invest in a company that is losing money and then eventually go bankrupt, right? You wouldn't want that. So the idea here, when we use fundamental analysis, for me, okay, is I always ask myself, okay, to do a mental check if this company is strong or not, okay, is that if I couldn't sell my stock for the next 10 years, so for example, right now it's 2021, if let's say I'm looking at a particular stock, okay, and once I invested in this stock, I'm not able to sell it all the way until 2031, okay, assuming that, of course, this company can last for 10 years, right? Would you still love to own this business? If the answer is no, then you know fundamentally you don't really believe in this company. Okay, because if you really believe in this company, then you are actually investing and owning this company, and you would want to own it even after 10 years because you strongly believe that this company is solid, right? Okay, so this question here to me is a very quick mental check whether the company is fundamentally strong. Okay, so you can name any company that you have perhaps in your portfolio right now and ask yourself that 10 years down the road, would you still want to hold this? If not, then you are technically not investing, you're just basically trading the price. Okay, so that's the difference in it. Okay, so over here, I want to use some case study as well on how fundamental can help you in your investing journey and why is it important. Okay, because this one here I want to talk about Apple. Okay, of course right now Apple has been hitting new high. Okay, but Apple also deep, that means the price actually dropped. Okay, actually dips in March 2020 as well. Okay, but fundamental companies that are strong provides you with the conviction to hold on to it because you know it's there. Okay, it's gonna tide through the challenges, and eventually this company is gonna improve and it's gonna becoming stronger. Okay, so over here I want to share with you this one on a position that I had on Apple. Okay, so if you actually look at it on the screen below, you'll be able to see that I bought Apple on 2nd of March 2020. Okay, this position was actually initiated on 2nd of March, just a few days or 1 week before the entire market crash. Okay, so I got in at around $71. Okay, the market actually tanked. Okay, let me show you this. The market dropped as much as close to 26% from where I entered on 2nd of March in 2020. Okay, and I want you to ask yourself this question, right? If this is not Apple, because Apple, I think a lot of people nowadays already know this company. We have confidence in Apple, right? It's cash rich. But let's say this is not Apple. Maybe this is like some other companies that is maybe not very well known. Okay, and you invested in it and you see the stock price dip and drop by 26%. Honestly, I will also panic. Okay, if it's not a fundamentally strong company. But I know Apple. Okay, and I'm willing to hold on to Apple for the next 10 years, 15 years, even, you know, forever. That's my idea here on investing based on fundamental, right? So with that 26% dip, I'm not worried at all because I know Apple is a long-term game. Okay, and from there on, you see where we are right now. Okay, of course, this chart is last updated as of end of last year. Okay, it rallied back up about close to 150% from the dip. Okay, of course, I didn't get in at the very bottom, so you see that my return wasn't like 100+%, right? It's just about 85. So this is where I want to show you, right? Fundamental is important, but you cannot only use it alone, okay? Because it's important to give you the confidence and conviction. Okay, if today this is not Apple, I would probably have panic sell when I see the price dip 26%. Okay, but because it's Apple, I'm willing to hold on to it. Okay, so that's the idea behind fundamental analysis. Why is it important? Okay, now the idea here is, again, I want you to then quickly take a few seconds to think about your whole journey of investing. Did you encounter something like this before, right? How many times have you sell a stock only for it to rally higher? Okay, it's probably perhaps you might not have done your fundamental analysis properly. You might not have the confidence or conviction when you initiated that investment. Okay, so that's why it's very important to make sure when you're investing, fundamental is good. Okay, so over here, again, I've developed a step-by-step framework for myself, okay, based on quantitative and qualitative. Okay, so very quickly over here, just to show you why I have that conviction in Apple. Okay, because based on this scoring here that I have, 21 is the max score for any company. Okay, and honestly, you will not see a 21 score company. Okay, because then that becomes like the ideal. Okay, so to me, as long as it's something above 15, okay, it's good. Okay, it's a fundamentally strong company that I'm willing to hold on to. Okay, so Apple actually gave me a scoring of 16, right? Pretty decent. Okay, and of course, there's the qualitative. These are some of the questions that I asked myself. Okay, you do realize that question 6 is where I feel is the most important. Where you ask yourself, if you couldn't sell this stock for the next 10 years, would you still love to own this business? Hey, if your answer is no, then you are not fundamentally investing in the company. You are perhaps just trading short term. Okay, so that's the idea behind it. Okay, so again, all this you will have access to the slide. Do not need to panic and copy down or take photo or things like that. You get to download the slides. Okay, I want you to really be present and focus on the sharing. Okay, and of course, if you have any questions, write that down first. We have a Q&A session at the end of this session over here. Okay, so now after that, okay, that's where we go into the fourth principle. Okay, technical analysis. Okay, for traders, this is like the sexy part of things. Okay, but there are also some investors I know, they say that there's no need to look at technical analysis. Now, there are only two reasons why people would say this. Number one, they tried and they just didn't fully understand what technical analysis is, so they just brush it aside and say that it's not important. Number two, they are just simply lazy, okay, to actually incorporate this into their investment strategy. Okay, because to me, it's like a tool, right? Today, if you have one additional way to do confirmation, why not? Okay, so to me, technical is important, fundamental important. In fact, okay, why I'm sharing you all these 6 strategies principles is because to me all of them are important. Okay, so today I'm not here to like debate and prove which is better. Okay, I'm simply presenting to you objectively all the principles over here, okay, that I feel personally is very important. Okay, so technical analysis to me is important, but sometimes traders or even investors put overemphasis on it as well. Okay, so you need to have a balanced point of view. Okay, it's important, but it's not everything. Okay, so again, I would like to use some case studies as well to share with you. Okay, but for those of you perhaps have never come across technical analysis before, you have no idea what it is. It's basically just the study of what happened in the past based on the price movement, based on a chart, to identify some levels that perhaps you'll be keen to be investing in a company. Okay, so there are definitely many different ways to look at technical analysis. You have like over hundreds or even maybe thousands of technical indicators out there. But for me, okay, the idea is don't go looking for that sure win 100% accuracy kind of things. Okay, there isn't such thing in the market. Okay, even for macro sector fundamental, there's no such thing as 100%. Okay, so do take note of that. Okay, so for me, I talk about this, right? You hear about fundamentalists claiming technicals are not important, but to me, it's very important. Okay, give you a case in point. Okay, and of course, I want to quote some famous traders as well, right? So this is by Fred McCallan. He said this: entry and exit points are vital part of trading investing. Okay, anyone who says entry and exit are not important, you're basically just trying your luck, right? Entry and exit is important, okay, because it determines how much money you make, whether it's going to be winning or losing. Okay, so he said this, that is worth repeating, right? So you want to repeat it again entry and exit points are vital. So whether you are day trading, swing trading, or you are an investor, okay, this is in his quote, right? He asked, why would you ever buy a stock at the wrong timing? Okay, so if you take a look at fundamental, it doesn't really tell you the time, right? It just tells you whether this company is worth investing. Is it good? It gives you that confidence and conviction. But if you look at technical, it does give you that time element as to when you want to get it. Okay, so I'll use this case in point, Intel, okay, INTC, also last year, a trade that I personally take. Okay, so I'm going to use Intel as a case study over here. Okay, so if you take a look, right, this is a chart from the starting of 2020 to as of where I screenshotted it. Okay, the maximum drop of Intel stock price was 30%. Okay, so imagine if you don't use technical and then you just invest into Intel at the start of the year, this drop was actually 30%. Okay, which means whatever amount you invested in Intel, you have lost 30%, even though Intel has a fundamentally strong score. Okay, so again, this proves that fundamental doesn't move the price. Okay, it can be a very good company, but price can still drop. Okay, so over here with the right timing, okay, I want to show you, right, over here with the right timing, in fact, I've invested, I'm still holding on to Intel. Okay, the position is up by about 16%. Okay, not like huge fantastic result, but there's a huge difference between a 33% drop or 30% drop versus a 16% gain. Okay, so how am I able to capitalize on this while, you know, the entire price was falling for Intel? Okay, the idea here is technical analysis. Okay, it's important to catch the time. When is the right time to enter? You do not want to enter at the high and then the price drop. You want to enter at the low and then there's a higher chance that price will rally because of perhaps fundamental reason as well. Okay, so that's why technical is important. Now, today I wouldn't want to go into a certain method of technical analysis because there are really just so many ways to look at a technical chart. Okay, and all of them work. Honestly, all of them work. Okay, you just need to find out which one suits you. Okay, so from there we need to understand valuation as well, right? So this one here is also very sexy term with like most fundamental traders, right? They like to look at valuation model to understand whether it's overvalue, undervalue, and then from there, is it worth investing? Is it worth holding? And things like that. Okay. Now, to me, it's important. Obviously, valuation is good, it's important, but again, I want to show you some case in point where valuation might hinder your investing journey. Okay, so this one here I have to bring in understanding what is valuation first again. Okay, and I have to bring in some case studies to illustrate you. Okay, so basically valuation analysis, you might hear about this term here called intrinsic value, okay, or IV for short, where you basically study right now with the current market price, is it below intrinsic value? Is it below fair value? Is it at a discount? Or is it overvalued? Is it expensive? Okay, so the idea of how most investors use it is that if it's discount, if it's undervalued, you buy it. Okay, if it's overvalued, you don't invest into it, or perhaps you're looking to sell it. Okay, so that's the idea behind it. And there are various models. Okay, and of course, some of the most common one here is like your discounted cash flow model, DCF. Some investors look at Graham's number. Some of them look at this dividend discounted model, in short, DDM. Okay, so there are of course more than this, but these are some of the common ones. Okay, and we talk about valuation, right? There is merit. Okay, and a lot of beginner traders, including myself, right, fall into the trap of like, wow, it's sexy, it sounds cool. Let's dive all deep in to understand valuation and how to calculate like the most accurate valuation so that I will be able to profit when I enter at the discount, right? But I want to share with you here is at the end of the day, it's really just for reference. Okay, there's no such thing as 100%, and valuation here is again not 100%. Okay, it's just a calculation, a modeling process for us to reference as to whether now is it fair or not. Okay, and one key maybe advantage of valuation here is perhaps to provide us with some psychological comfort when we make our investment decision, right? So the idea here is, let's say you calculate this valuation and today the price is undervalued. Psychologically, you feel good you feel comfortable to invest in it. Okay, but let's say if today I tell you the model here, valuation tells you it's overpriced. Okay, then you might feel a little bit not comfortable. Okay, so again, all this I want you to be aware that it's really psychological aspect of things, right? So it's again just for reference. Okay, and when you talk about value investing, the first person that comes to you probably is like Warren Buffett, and one of the most successful investors out there. He said this: price is what you pay, value is what you get. Basically sums up value investing, right? In other words. Okay, but at the same time, he didn't invest in Tesla. Okay, and I'm not sure how many of you are aware of this. Tesla is like the hottest stock late last year and early this year, right? It made Elon Musk like the world's richest man right now. Okay, but at the same time, Warren Buffett said this, right? When he was asked, when it come down to the $1 million question, whether or not Buffett would invest in Tesla, okay, he basically answered no. Okay, and he missed out on the entire thing. Okay, so bear in mind that Buffett did not invest in Netflix and he did not invest in Google as well. Okay, because he has his principle. Okay, and his investing principles is based on value investing. Okay, and honestly, if you take a look at Tesla, it's very difficult to actually put a valuation to it. Okay, because those model to calculate the valuation just does not fit into Tesla company in terms of the environment that Tesla company is right now. Okay, if you take a look at this, I'm not sure if this is the latest one. I got this at end of last year. Okay, so you can see that Tesla net income as of 2016 to 2019 is already negative. Okay, which means that this company as of like annual basis, right, is losing money from a net income perspective. Okay, so if you put into valuation model, there's no way you're gonna have a valuation out because this company is not making money now. Okay, and that's the reason perhaps why Warren Buffett is not investing into it. Okay, but you know, you can't deny the fact that the price of Tesla has been shooting up all the way up, right? So how do you value a company that's not profitable? Okay, there's no way. Okay, so that is actually the disadvantage, or I would say like the shortcoming of valuation model. Okay, so right, this is not even the latest stock price. Okay, you can see the stock price here as of when I screenshot was only about $619. Today I think it's about $800, right? So itself 2020 Tesla was crazy. Okay, so I want to share a view over here. Valuation is important, but it shouldn't be something that stop you from your investing or trading. Okay, because there are certain kind of like shortcomings of how a valuation model works. Okay, so I actually got involved in Tesla, but I got out like $700. Okay, and that was before the stock split. Okay, so I got out at like April. Quite dumb for me. Okay, I missed the entire run, but yeah, it's a trade, it's not an investment, because I wouldn't want to hold on to Tesla for the next 10 years, right? For reason because fundamentally it's still not profiting. Okay, so that is my principle as well. So this is a trade I got out like way too early and missed out on the entire move. But again, case study in point, right? Why I talk about Tesla? Because I was involved in it. Okay, I want to use case study that I personally took. Okay, so for me, valuation is maybe only useful for me when I talk about dividend investing. Okay, so I use the dividend discount model. Now, over here, I also invest in companies based on dividend growth, which means that I'm looking at it, I'm investing in it for long term. Okay, even towards like lifetime holding. Not really value investing because I specifically want companies that pay off good dividend and the dividend is going to be keep growing. Okay, so example over here is BlackRock. Okay, and the ticker symbol of course is BLK. Over here you can see on the right, that's the dividend model that I use, DDM. Okay, so you can see the current IV is 982 because based on the valuation model, you factor in the dividend payouts. The fair value is at $980 based on BlackRock. Okay, and the current price when I did this presentation slide, when I was preparing it, it was $700. Okay, so with an annual dividend of $14.52, and of course the expected dividend growth rate of close to 13%. Okay, so how I got this is basically the average of what BlackRock has been doing for the past years. You just take, okay, so there is a little bit of like estimation, but at the same time, you can base on historical data that the company has been doing. Okay, so that gives me a valuation of $980. Okay, and of course, in this model here, you realize there are some metrics you need to put in yourself. For example, like what is the terminum growth rate? Okay, so for me, I put like 5%, and the expected return for me on an annual basis in this investment is 8%. Okay, so with all these metrics here, that's where it's calculated. Okay, so the valuation was there, and with the current market price of $700, based on valuation model, it tells me that it's still undervalued, it's still at the discount. Okay, so it's still worth investing. So that's from that perspective. Okay, so I actually got in like way earlier, so I got in at like 471. Okay, so again, why I'm using this is because these are actual principles that I personally use in my own investing, dividend investing journey. Okay, another one here that for you to also consider is ticker symbol AVGO. Okay, it's called Broadcom. Okay, so this one here, you can see same method, right? Basically, the dividend, annual dividend I just inputted is a data, $13.35 per year. Expected growth rate was crazy. Okay, this 47.15 per year growth rate on the dividend was what it has been doing. Okay, but honestly, if you ask me, it's not going to be sustainable. How to grow a dividend 50% year on year, right? That's crazy. Okay, so it's not going to be sustainable. So that's where the dividend discount model, you need to also come in and make some adjustment in the metrics. Okay, so for me, it doesn't make sense for a valuation of a company like this to be valued at 11,000. Okay, doesn't make sense at all. So what I did was I actually put kind of like reduce the dividend growth rate to 10%. Okay, from what it's doing for the past years is 40+%. I reduce it to 10% to see if it's still worth it. Okay, so if I take a 10% growth rate, the valuation is still at $700. Okay, current price back then was $400. So it's still worth investing from a valuation point of view. Okay, so I got in at about 275. So I want you to see that valuation, do I use it? Yes. Okay, but is there shortcomings to it? Yes. Do I, some companies, do I ignore valuation at all? Yes, like Tesla, right? There's no way you can value Tesla based on all this model. Okay, so I want you to see that point. Okay, and appreciate there is the usefulness of it, but at the same time, perhaps not so ideal at some point in time. Okay, the last one over here, okay, is called seasonal analysis. Okay, and this is the part where I think perhaps not many of you are aware of. And recently I've put in a lot of study into this, and so far it's been very useful for me. Okay, and the idea of seasonal analysis over here, to quickly introduce to you the concept, is that it's studying what has happened in the past, historical pattern, and we are studying what are the tendency of it repeating itself throughout the years. Okay, and we want to just capitalize on that based on the statistical point of view. Okay, so there are multiple factors that can contribute to this recurring pattern. It can be political, it can be economical, it can be business cycle, it can be really because of seasons, especially when you deal with like agriculture, mining, and things like that, right? Many factors. Okay, but at the end of the day, we are not so much interested into the why, but we are looking at just the statistical edge. Okay, so if I know that there's a certain probability that this stock is going to rally during this period, I'm interested to take risk in that, to profit from it, then that's all I'm interested in. Okay, so that's the idea of seasonal analysis. Okay, so over here, for those of you who would like to understand a little bit more, okay, there's this very in-depth study and report by Global Factor Premiums, where they basically, in this research, they study all different methodologies to approach the trading investing in the market. Okay, and they realize that if today you incorporate seasonal analysis, seasonal trends, the performance of the method tends to be like the best. Okay, so if you like to just Google Global Factor Premiums, you'll be able to find out that report, give it a read. Okay, it's pretty dry, but for those of you who are more perhaps academic, you would like to understand more, that's where you go to. Okay, now when we talk about seasonal, perhaps one of the most common term you hear in the trading investing industry is like sell in May and go away, right? So I'm not sure how many of you, really go and track this, okay? But a lot of times you hear this phrase, sell in May and go away. Basically, you know, exit your market, don't trade, don't enter in May, and that's it, okay? And the idea is there are some people who says, nah, it's not gonna happen. Then there are some people who strongly believe in it. And you know, for me, Tesla, I fell into that, right? You realize I liquidated my Tesla end of April because of this, okay? But what I want to share you, the interesting part here is a lot of times we say sell in May, okay? But how many of us actually went in and studied the statistics of it? Okay, so the idea here is I went in and find out a little bit more in terms of statistics. Does it really make sense that you sell your stock in May because there's a high probability of it falling? Okay, so I went in and did a research that it's true based on the 50 years historical data that the S&P index between May and October tends to be slower. Okay, now this one here is true because it tends to be slower, but at the same time, the peak in the S&P index in terms of the price of it is not in May, okay, but it's rather in July. Okay, so in fact, the phase of sell in May and go away should be changed into like sell in July and go away. Okay, it's not really May. Okay, so based on statistics, then you know it proved that this theory or this like the saying of sell in May doesn't really stand based on statistics. Okay, so the idea here on sell in July and go away, even I can zoom in to the specific date of the statistics. Okay, so for the past 50 years, from 17th of July to 26th of October, the S&P rallied 26 times and dropped 24 times. So it's more like 50-50. So it's not like confirm it will drop. Okay, it's more like 50% of the time it will drop, 50% of the time it will rally. Okay, but what's also important is to understand based on this 50 years, if every year you invest 17 July to 26th of October, what's your performance? Okay, so if you take a look at this, if you do that, you basically have an annualized return of negative 5.67%. In other words, you lose money. Okay, and with the maximum loss, of course, in 2008, it dropped by 32.64%. Okay, the maximum gain was back in 1982, which is quite obsolete for now in our context. It rallied 21%. Okay, so these are some statistics, and the only way for you to really understand this is to base on seasonality. Go dive deep into the statistics. Okay, so between May and July, in fact, you know, if I break it down, because the phrase of sell in May to is not really accurate, right? So I want to study from July to October and then from May to July how it happens. So between May and July, you realize that actually the rally was like 68%, okay, probability. So the reliability factor is 34 times it rallies, 16 times it dropped. And if you actually invested from 1st of May to 17th of July, you actually made money. Okay, the annualized return was 7.39. It's a positive number. Okay, and of course you have the maximum gain and the maximum loss during this window period as well. Okay, so I hope you know through this part here you can see how statistics plays out in helping you in making decisions. Okay, so for me, right, so the question I ask myself is, with such data, then wouldn't I make my trading investing decision more confident or even with more conviction, right? The answer, of course, is yes. Okay, and with that, I also want to show you these are just some of the trades that I took just purely based on statistics. Okay, no fundamental, nothing. Okay, it's just based on, okay, there's a high chance that this stock is going to rally. I get in, I get out during that period of the window period. Okay, so again, I want to share with you all this because to give you the perspective that it's not theory. Okay, it's really things that I personally apply. Okay, so with that, okay, I think I might overrun a little bit. Okay, but with that, I want you to see, right, with this 6 strategies. Okay, a lot of times people like to ask and compare. Okay, so Kar Yong, which one is the best? Okay, to me, I hope through this entire presentation you see and you realize there's no such thing as the best or the most important. All of them is important. All of them plays a certain part in your entire investing and trading journey, right? So to me, all of them has their strength. Okay, and the question I always throw back to traders and investors is, why not have them all? Okay, so that when you want to use this, you can actually know, okay, this one is suitable for this. This is the strength of this methodology. Let's use it. Okay, so that's where I want you to be able to see that perspective. Okay, so of course I'm not saying that in a short period of time you'll be able to acquire all of this, but slowly build them up into your toolbox, because you never know when you will require them. Okay, so that's my perspective when you ask me like which one is important. Good. Okay, so I hope my pace is so far so good. Okay, I might overrun a little bit because we haven't done up the Q&A, and then I have some little bonuses segment to share with you in terms of like my outlook, okay, my personal outlook. Okay, so but before that, because you guys, as I promised at the start, right, if you actually stay present all the way until now, you'll be able to download this entire slide deck. Okay, you just need to head over to this website over here, and you'll be able to just download it for free. Okay, if you need to quickly take a photo of this slide, screenshot it, whatever, do it later. Okay, I don't want you to do it now, because now is the opportunity for you to ask questions. Okay, but before that, just quickly, some of you actually did kind of like PM me because I was sharing that there's this webinar. Some of you actually asked me what is my perspective on these stocks here, right? There's a mixture of, some of them are US, some of them are Singapore local stocks. Okay, now I'll quickly share with you my perspective on it. Okay, I will not go into like full-on analysis, okay, but just quick one. Okay, let me change the color here. Okay, NIO, okay, is again a very popular stock because of EV, because of Tesla perhaps. Okay, but my first impression on this is I will never touch it. Okay, reason very simple, because it's Chinese company. Okay, so nothing against any race or country. Okay, but just wanted to point to your attention towards what happened in Alibaba. Okay, what happened to Jack Ma, what happened to Ant Group, is basically just how much power and control the Chinese government have over the companies. Okay, and it's not very transparent. So to me, whenever someone asks me about my view of a Chinese related investment company, okay, I will always suggest that I will not personally invest in it, simply because of how much power and control the government has. It can just easily, nationalize that company, delist it, and that's it. Okay, so if you ask me, NIO, it can be a very good company, it can push up in price, but to me, I will never touch it. Okay, next one here is TSM. Okay, is actually a semiconductor company in Taiwan. Okay, to me, if you pay attention to the sector rotation we talk about, right, this year itself we are going into early recovery. Industry, basic industry, industrial, energy, semiconductor will be the one performing. Okay, so you can pay close look to TSM. Now, I'm personally not involved in like Taiwan companies. Okay, my focus a lot will be on US. Okay, to me, that's where the opportunity really is. Okay, but TSM is something that you can of course take a look at based on sector. Okay, BYD is a gaming company, again slightly related to technology, in that sector. So definitely you can still take a look at it. I never go into like the full-on fundamental, but nothing stand out to me. Okay, so like this one here, I would strongly just say no from my personal point of view. Okay, now banking stocks. Okay, I would suggest do not go into finance banking stocks for this year. Okay, why? Because you need to understand a little bit how does bank make money, right? One of the main source of income bank make money is perhaps through interest that they charge. Okay, and with the recent times where banks are reducing their interest rate, that's where their profit margin is getting thinner and thinner. Okay, and usually this is the period where you don't see the finance sector perform. Okay, so I wouldn't suggest you to focus on it. Doesn't mean that it's not going to rally. Okay, it's just that I wouldn't pay too much attention to that. Okay, so take note of that. ST Engineering, that's a Singapore listed company, is one of the blue chip, right? So I would say it's perfectly fine, okay, because especially right now, if we are going into like you need to pay very close attention to also the fiscal policy in Singapore. Okay, is the money gonna flow into this sector or this company? Is it gonna, be one of the company that has like government projects, right? If they are, perfect. Okay, so to me, ST Engineering is okay. You can keep a close look on it. SAT to me is nope. Okay, for one very simple reason, most of its revenue, I would say, is related to like airlines, airports, and you know, right now, okay, that's like one of the hardest hit industry, right? So to me, just don't focus there, right? Go somewhere else. Okay, ComfortDelGro, perhaps you might want to be cautious as well. I don't think there are much room for it to rally. Again, take a look at that. There's no dividend paying. I think it's zero as of now. I might be wrong, okay, because Singapore, I might have limited updated information, okay, because I only can go to like investing.com, those public websites, to search for information, right? Yeah, so for me, I wouldn't pay too much attention to this, okay. I'm not sure exactly right now in terms of Singapore scene, how well, okay, because ComfortDelGro is like taxi related also, right? And of course transport, okay, transportation. So you might want to have a localized view and understanding of how the environment is in this industry. I've been back in Malaysia for like 3 years, okay, so I wouldn't be able to comment much on that, okay, but it's important for you to go and understand, okay. But from a number quantitative fundamental perspective, it's a solid company, but I personally wouldn't be investing into it because I'm not a value investor. Okay, I'm more of like a dividend growth as well. So if I don't see a potential in the dividend growth, it's not a company I would invest as well. Okay, REITs, stay out. Okay, 100% stay out for REITs. Okay, personally, I'm a bit like biased on risk. I never have an interest investing in REITs. But if you just take a look at what's happening right now in shopping mall, retail scene, retail market, right? Everyone is closing down, most of them, right? Why would you want to invest in REITs? REITs will be like, after all this company closed down, you realize that the REITs company is going to suffer because there's no rental, right? So I will not suggest you to go into REITs this year. Okay, be patient on that. I'm not saying REITs will not make you money, but at least for me, 2021 is not a good one. Okay, so these are some of the quick one. Hope you know to answer some of the stocks that you guys sent in asking of my opinion. Okay, so I hope it's clear. Okay, good. Okay, so now before I go into question, I think you guys are sending in question already. Okay, just want to share with you my watch list. Okay, so again, you get to download this. All these are included in the slides. Okay, I'm not saying that you want to buy now or invest now. Okay, these are just basically the stocks that I'm personally monitoring. This two here, okay, is one of my favorites, Apple and Microsoft. Okay, so let me just share with you a little bit of my view going forward as to what are some of the potential trends coming in. Okay, I personally feel that you want to pay attention to technology companies or innovation companies that deal with AI. Okay, AI will likely be the next trend, and I can safely and confidently say that 2020 has hastened the adoption of technology. Okay, now ask yourself, right, before the lockdown, how would you favor something like this online? You would rather attend it, a live event, physical event, right? How many of you started using Zoom or get to know Zoom because of the lockdown? Okay, and you have no chance, you have no choice. You are forced to adopt. Okay, and that is perhaps the process of it. Okay, there is a hastened process of technology adoption. Okay, so AI is going to come next, and I personally look at these two companies for potential here. Okay, Apple and Microsoft potentially has the leading resources to lead the AI scene. Okay, the next trend you might want to take a look at is green energy. Okay, clean tech, clean energy. Okay, and NEE is one of the companies that I think you want to pay very close attention to. Okay, so for me, this too is very important. Okay, so let me share with you that. Okay, of course, the rest you can keep a look at it. I don't have the time to go into detail everything. Okay, so let me quickly walk you through this, and then we'll go into Q&A and answer your question. Okay, so Apple over here, the idea here is when to focus, right? So again, I'm using the different principles that I have to share with you this analysis. The fundamental is solid for Apple. I think all of you should know by now. Okay, the valuation of it, there's really no way to value Apple based on value investing. Okay, so I'm basing on seasonality to give you some statistics here. Okay, so based on the past 25 years of data, which includes the dot-com bubble in 2000, okay, which includes the 2008 financial crisis, there's a 64% probability that during 8th of May to 27th of June, Apple price actually dropped. Okay, and the average drop was 3%. Now, why am I sharing with you this statistics and data over here? Because if I'm looking to invest in Apple, I want to know when will there be a chance where Apple price will drop so that I can scoop it up at the bottom, right? Then I'll incorporate technical as well. So a combination of this, right? So you see all this coming in. So why I'm sharing with you when Apple will drop, because when Apple drop, that's where you want to pay close attention to, right? You wouldn't want to buy at the high, you want to buy at the low. Okay, so take note of this data. The other one is Microsoft. Okay, so same thing here between 26th of January to 12th of March. There's a 56% chance Microsoft price will drop, and the average drop is 2.37%, which means during this period when it's dropping, perhaps you want to look out for opportunity to get it. All right. So that's the two stocks, okay, that I'm personally very I have a huge conviction in these two companies. I'm paying very close attention to them. Okay, Apple, I'm already in. Microsoft, I'm not in, but I'll be looking to get in with perhaps a little bit more, building up my position on Apple and Microsoft as well. Okay, so that's the two companies. Okay, good. So now let's take a look at some of the questions that you guys have. Okay, okay, so I might not be able to answer a lot of questions because I understand that I overrun by 5 minutes by now. Okay, but let me answer as much as I can. Okay, so the first question I get over here is how do you start searching for a stock in a particular exchange? Okay, I think many of you are probably asking also, right? How do you start filtering stocks? Okay, there are so many stocks in the same industry. Do you search all stocks or go through one by one in NYSE? Okay, Daniel asked this question. Okay, it's crazy if you go through one by one. Okay, so never do that. Now, in fact, one of the easiest way to do filtering, okay, there are many approaches. Okay, for me, the easiest way to approach and filter stock is through a filter kind of like feature. Okay, in fact, today a lot of platforms have that, even free. Okay, so if you go like TradingView, investing.com, Yahoo Finance, they have some form of filtering process. Okay, and that's where you want to utilize the quantitative fundamental analysis to quickly filter out stocks. Okay, so put in like, okay, I want to make sure that this company is making money. I want to make sure that the profit margin is of a certain percentage, the ROE, ROA. Okay, all this are where you can quickly utilize fundamental quantitative data and analysis to filter out stocks, because you wouldn't want to invest and look at stocks that's not performing, right? So that's one way. Okay, basically using quantitative to filter. The second is you start top down. Okay, so like what I just shared with you guys like 5 minutes before about Apple and Microsoft is really from a top down. So what I did was I start looking at where is the next potential trend. That's where it leads me to identify, okay, potentially next trend here might come in is AI. Okay, then from there I start to look up where, okay, which are some of the companies that might have the capacity, the resource to really fully take advantage of this next trend. Okay, and that's where I go into Apple and Microsoft, right? Because Apple, if you take a look at it, is starting to build its automated smart vehicle. Okay, recently it's released its M1 chip, okay, which is great. Okay, so in terms of Apple, it has, number one, the cash to do it. It has the resources to do it. It's in its technology industry. It has its leading capacity in that. Okay, Microsoft, why? Because again, it's in tech, and Microsoft here, it deals a lot with education. It deals a lot with workforce. Okay, Microsoft offices. So when AI comes in, okay, this is where I see Apple and Microsoft would have the capacity to immediately take advantage of it. Okay, so that's the second approach of how you can select and filter stocks. Okay, so I don't go like one by one. Okay, I don't randomly pick. Okay, and that's the third way to do it, which I personally feel is not bad. Okay, it's not a bad way. The third way here is of course through forums. Okay, I'm pretty sure many of you today attending this webinar are in various forums like Facebook group, online forums, and things like that, and then where you can actually hear a little bit tips here and there. Okay, now those are a very good avenue to have like ideas. Okay, but don't just take them blindly, but these are good ideas. Okay, even on YouTube. Okay, there are certain channels that share about, okay, this month these are the stocks you want to take a look at and things like that. That's where ideas comes in. Okay, so 3 ways, right? So I hope that answer Daniel's question, and maybe some of you also have that similar question. Okay, another question that I received over here is SMBVD, how do I get exposed to all this, because I've never heard of them before? Is there a list to search more of them? Okay, maybe honestly, I'm not very familiar with the term here, SM and BVD. Okay, let me be very honest with you, I have no idea what they are. Okay, maybe if you can explain a little bit or give the longer full name of it, because I believe that's a short term of it. Okay, so I don't know what they are, so I won't be able to help you in answering that question. Okay, okay, so maybe I'm not sure who asked that question. Okay, so if you want, you can actually let me know a little bit what is that. Okay, another question I get over here. Okay, let me. This question is popping in. Okay, asked by CK. Okay, industrial REITs or healthcare REITs. Okay, now if you ask me, right, I personally don't like investing in REITs. Okay, now I know most, okay, not all, but most REITs investors are investing in REITs because of the high dividend yield. Okay, and maybe sometimes, you know, price gain. Okay, but I know most investors that invest in REITs is really because of the dividend. Now, to me, my view here is that there's much better opportunities to look out for dividend growth in these individual companies as compared to REITs. Okay, because the understanding of REITs here is that it's a company that manage real estate, right? So they have many properties and then they rent it out, and then that's how they make money. Okay, so you realize that there are multiple layers of how a REITs company is being affected. Okay, so if number one, they need to acquire a property. Number two, they need to rent it out to actually start seeing their income comes in. Okay, or perhaps they can sell away the property. But there are a few layers. So the first layer here is they need to make sure that they selected and purchased or invested in a good property. Okay, the second layer here is they must rent the property out, or else they won't have an income, or they must sell it off to make a profit, or else they won't have an income. So then you need to then analyze, okay, what will affect the rental of this property? Okay, and you realize that REITs are not only just local. Sometimes they might invest also, I mean, a REIT company might also invest and manage like overseas property. Okay, so to me, there are just too many layers of analysis for one to go and determine whether this REIT company is good or not. Okay, now there are of course simpler way to do it. Okay, but to me, when I have all this question, I don't have the confidence and conviction in it. Right? So that's why I don't invest in REITs. Now, if you ask me industrial REITs or healthcare REITs, then the question is, why not you just invest directly into healthcare related companies if you're interested in the healthcare industry? Okay, if I were to just scroll up a little bit to this here, you can see some of these companies are in fact, okay, healthcare. Okay, okay, of course, like mRNA, Gilead, Pfizer, they are related to COVID-19 vaccine as well, right? These are more like laboratory healthcare related. So to me, okay, healthcare is also important, especially this year and next year because of the situation we are in, right? COVID-19. Okay, but I wouldn't put my money at risk. REITs, okay, because of the reasons that I talk about. Okay, so for CK, perhaps some of you are also asking about REITs. Is not something I will personally touch it. Okay, if I'm looking at dividend, okay, some of this company dividend is pretty solid. Okay, in fact, all of this here, okay, even Microsoft, okay, Apple is not. All of this except for Apple, they are dividend paying company. Okay, they are dividend paying company. So for me, I'm always looking at dividend investing. Okay, so the companies, most of them when I'm investing, all have dividend in it. Okay, so I hope that gives you a different perspective. Okay, I might don't take my answer for like that's the answer. Okay, there's no such thing in investing and trading. That's my view. Okay, that's my perspective. Take that as like a 2 cents view. Okay, and see if it aligns with you. Okay, just to give you a different perspective. Okay, another question from Chia. Okay, do you know relative price to sales ratio I think it can be used to calculate those potential companies, but not making profit right now. Yes, okay. Now I understand that perspective. Okay, that's great view as well. Okay, I never really think about it, but when I read your question, okay, when we talk about relative price to sales ratio, yes, okay, for example, some companies might be good to look at this, especially for companies who are perhaps like new, okay, fast growing company, maybe they are not making money yet, okay, like maybe early phase on Facebook, right, it's not making money, but right now it's cash rich, okay, there is this matter, okay, of course you can do it, but for me is that what if, okay, let's say now it's not making money, but you're looking at this aspect to analyze the company, and then suddenly the economy shift, right? Like something happened in 2020 and then affected the company, and then the company doesn't have a solid kind of like backup resource to tank through that period. Okay, and that's where a lot of company collapse, go bankrupt. Okay, so you need to also understand from that perspective. So for me, when I invest into a company, right, I'm looking at long-term gain. Okay, long-term gain here, I'm looking at like 10 years, 20 years, or even a lifetime, right? So the idea here is like, for example, Apple, Microsoft. I don't think, okay, these companies will go bankrupt unless maybe really something big changes, and then that's another story. But based on just this trajectory of how you view the next 10 years, 15 years, I don't think like companies like Apple and Microsoft will ever go bankrupt. Okay, so that's where I'm coming from when I talk about I don't want to invest in companies that are too new or they are not making money. Okay, but at the same time, I do trade them. Okay, so they are not investment, they are trading decisions. So I look at like, okay, the price is good, there's a potential for price to go higher. For example, like Tesla, right? I also trade it, but it's not a form of investment. I look to trade, enter. When the price go up, I look to exit. Okay, speaking of this, right, I'm not sure. Okay, so let me sidetrack a little bit. I'm not sure if you guys are aware of this company here. Let me exit this. Okay, of this company here called Micron Technology. Okay, recently it's also very popular. Okay, a lot of news are talking about it. I was looking at it for last year. Okay, but last year the data or the performance of this company wasn't great. Okay, fundamentally this company is not that solid. Okay, but the growth potential is there. Okay, so I was a little bit like mixed, conflicted a little bit, like should I invest in it? There's a growth in it, there's a growth potential, but at the same time this company, the fundamental is not solid. Okay, so that's where, you know, the question by Chia here is that, is there other ways to look at it? Okay, the price actually rallied. Okay, if you take a look at it, I totally missed this entire move. Okay, but this is one of the company that maybe, you know, that's where the company is not making money, the fundamental is not strong, but the potential growth is there. Okay, and maybe this is another one that you guys want to keep an eye on. Okay, Micron. I didn't put it in my slides over here, okay, because it's not one of the fundamentally strong one. Okay, all this here are based on, you know, the 6 principles. Fundamental is good. These companies are solid, so it's here. Okay, Micron is more like potentially a trade. Okay, so again, based on that, I just wanted to share with you on that. Okay, next question that I see is from Zachary. Okay, what are your views on SPAC? Okay, recently this also becomes very hot, right? And how do you have any recommendation on how to assess on this? Now recently this there are some investors and traders also ask me about this. Okay, to me, I always don't like to jump into something that is too new. Okay, so okay, first thing here, I need to be very transparent and share with you that I never go in detail or even in depth into like what is this, okay, or how does this mechanic works. I didn't go into details. Okay, I just briefly read about it because someone asked me before. Okay, same thing as like you know, things like Bitcoin, cryptocurrency. I never go into detail of like, whoa, how all this works. Okay, but I know from what I read. Okay, so I need to disclaim that first. Okay, so that whatever I share, okay, don't take it as like the truth, okay? It's just my personal opinion. Okay, so to me, number one, okay, these are where I think all these products, okay, I call this products because you can invest in it, right? All these products probably are released like recently because of the same, hype that Robinhood did. Okay, so like 2019, 2020, Robinhood was like top hot topic, right? In the news, is always appearing, where they attract a lot of like retail traders in because it's easy, they make it fun, it's easy to start trading and investing into the stock market. Okay, so that's like the Robinhood. So I think something like this, the product on SPAC, right, is potentially similar concept to what Robinhood wanted to do. Okay, is basically riding on hype because there is like demand coming in. Okay, and they want to capitalize on this demand, and then therefore they created this kind of like products to give access to retail traders. Okay, so to me, I wouldn't want to touch it. Okay, same thing like what happened with the whole Robinhood thing, where every retail trader jumps in just because they can start trading stocks, and then even bankrupt companies like the other one that is a car renting company. Okay, the name basically just slipped me. People are trading a bankrupt company. Okay, that's like insane. Okay, but of course they still can make money, and a lot of people lose money on it. But why would you trade a company that went bankrupt, right? That just announced. Okay, so same thing here. I would suggest that if you can, don't touch it. Okay, okay, again, ask yourself, why would you want to put your money at that area or in that product where there is a safer, much lower risk alternative? Okay, it's not like there's no opportunity out there, right? Opportunities are available everywhere in other financial products. Why would you want to put your risk there? Okay, so that's the question perhaps you might want to ask yourself, and from there you can give yourself a much better understanding as to why you want to focus on it. Okay, so for me, I won't touch it. I won't recommend anyone to touch it. Okay. Okay, another question here that I received from Wong. Okay, any recommended apps or calculator to calculate intrinsic value? There are, but not that I know of that I use. Okay, so I'm pretty sure there are different calculator apps or even website out there to calculate intrinsic value. I built the model myself over here for the DDM, right? Okay, just a quick one to show you. Okay, this valuation model that I put in here, okay, this one is basically just Excel spreadsheet, but I just utilize the concept of discounted dividend model. The formula of it, I think you can find it very easily online as well, and then I just put it into an Excel, then automate a little bit of it. Okay, but basically the calculation, the formula, you can find it all online. Okay, even in DCF you can find it online. Graham's number you can find it online. Okay, even DDM you can find the formula online. Okay, but so far I've not known any that provides you a direct calculation. Okay, and most of the time you might also want to cross check a little bit. Okay, so instead what I did was I just built one myself based on the formula. Okay, because sometimes you find a calculator online, right? It might not be the actual calculation formula that you want, because different investors might have slightly different formula. They might tweak a little bit here and there. Okay, so just take note of that. Okay, yeah, so I can't answer you that because I don't know if there's any of it. Okay, Yo asked which website to go to for global premium factors. Okay, actually, if you downloaded this slides, right, this is a hyperlink. Okay, if you click onto it, okay, it will bring you to the website. If not, then you just go to Google. Okay, the website here is SSRN, right? It's basically research paper being uploaded there. Okay, you'll be able to download this paper, and then you'll be able to read it. Okay, so if you downloaded the slide, actually you don't need to go and find the link, because I've already embedded the link into here. You just click it, it will bring you to the website, and then you can download the paper there. Okay, good. Okay, so Good. Okay, so I hope you guys have actually benefited from today's sharing. Okay, I know I was perhaps at some component a bit rushed because of a tight time schedule, right? I wanted to finish my presentation like 8 so that we have Q&A session. Okay, so yeah, so I hope you guys are still able to take some things out from it. Okay, good. So far I was told there's no more question. Okay, so just nice as well. Okay, we actually scheduled this until 8:30. Okay, so great. So without any more questions, then I think we can end the webinar over here. Okay, yeah, if you guys have any feedback, what things you like about this, would appreciate if you can send that feedback to CMC Markets as well. Okay, and then from there, I will also know like what are some of the things that I can improve on in terms of my presentation and sharing like that, so that for the future ones, I'll be able to make sure, okay, to benefit more traders and investors from this whole process. Okay, so with that, again, want to thank all of you to be here. Okay, took out your time to commit to this webinar, be present here with us. I also like to thank CMC Markets for actually organizing this, giving me this opportunity, this platform, to share what I know about trading and investing as well. Okay, so with that, have a good evening ahead, and I'll see you guys next time whenever that is. Okay, so bye-bye.